Hello and welcome to another fabulous Red Friday. Red because we remember everyone deployed here at Low VA Rates. We try to sport our red colors every Friday. So thank you for your service and welcome to another hangout video, whatever you want to call it. This is Eric Campbell with Low VA Rates, and today we are talking about the pros and the cons of the VA hybrid ARM loan. Okay, now it's the new year. It's January. I don't know if you can tell from the side here, but one of my New Year's resolutions was to lose, not even lose weight, but become a little bit healthier. So that wasn't a fun decision for me. I had to weigh the pros and the cons of eating healthier, cutting out junk food. Ultimately, like you see over here, the pros of a healthy lifestyle, for me at least, outweighed the cons. Now we'll check back in with me in March and we'll see if I still singing the same tune. I want to do the same thing today with the VA's hybrid ARM loan. And ARM is an acronym for adjustable rate mortgage. Now, if I say ARM or adjustable and you start to, shudder a little bit and there's immediate signs of anxiety and stress, you're not alone. Okay. We talk to thousands of veterans every single week, hundreds a day. And we try to educate them on the ARM loan that the VA offers because we love it here at Low VA Rates. However, we also have a somewhat of an uphill battle helping people release the stress that comes with the word ARM. Okay, so I'm only going to say it one more time to get you loosened up here. We're talking about the ARM loan today. I think to weigh the pros and cons, what I like to do is I want to talk about all the negativity first. Let's just annihilate everything we can about the ARM loan and tell us all the reasons why people don't do it. Well, number one, the most common concern that I hear is that because it's an ARM or adjustable, okay, undoubtedly my interest rate's going up. And that scares people because an increase in my interest rate at some point means my payment is going to go up. That's not good. And if my payment goes up, I might lose my home because I can no longer afford my home. And then ultimately, these ARM loans are what caused the big housing collapse. Now, if you're a new homeowner or a prospective homeowner, if you've had a newspaper, if you've turned on the news or you've listened to the radio at all since 2008, you have certainly heard about the housing collapse. And the media, unfortunately, has suggested to every single one of us, it's this ARM loan that must have caused the housing collapse. Not true. We'll talk about what truly caused the housing collapse, or you can go to our YouTube channel and you can research it right now yourself. So these are most of the common reasons that we have men and women in the military or VA homeowners tell us, no, 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 I'm not going to do the ARM. It's not going to do it. Okay. There's some validity to some of these cons. Most of them are just a misunderstanding of the truth. The truth is there's a lot of reasons. Okay. There's a lot of reasons that the ARM loan, in my opinion, is a very good loan to look at. First of all, your rate is lower. People don't ever stop to think about that. Not only is it lower day one, but it can also go down. Just like it can go up, here's what I've taught my kids. And I don't know if you guys learned this when you were younger, but we always heard what goes up, right? It must come down. Let's not just assume that our interest rate on our ARM loan is going to go up and up and up and up. It's also going to come down and down and down. Not to mention there is no guarantee it will go up, and we'll talk about that at another time. But today, we've got ARM rates between 1.7 and 2.75%. I'm sorry, 1.75 and 2.75. The APR, obviously, we like to disclose APR. We're very compliant here at Low VA Rates. Is going to be somewhere around 2.1 and probably 2.99, something like that. But this is the rates. These are the rates that you can get today on an adjustable rate loan through Low VA Rates. Now, if you were to come to us for a 30-year fixed loan, which we also do, our 30-year rates are going to be anywhere between 3.25 up to 4.25, depending on some variables. Which one's lower, right? The ARM loan certainly is always lower than a 30-year fixed loan on that same day when getting your mortgage, okay? Another thing, people love the comfort of the fixed. We just feel great. When I say fixed rate, nobody feels stress. When I say adjustable rate, we feel some stress. The fact of the matter is, the VA has packaged this loan in a way that allows you to choose whether you want to be fixed for 3 years or whether you want to be fixed for 5 years. There's actually even a 7-year adjustable rate mortgage, but personally, I don't think it's as good of a loan as one of these two. So why do you think we've picked fixed rate for 3 to 5 years? Well, if you look right here, you've all heard of Fannie Mae, Freddie Mac. You may not have heard of Ginnie Mae, but that's who backs these VA loans. Nonetheless, these are government agencies of a sort, and they're also private enterprises that have gone out and done a lot of research. And research suggests that the average homeowner, that's you, people I'm talking to, that's me, we are only in our mortgages for around 3 to 6 years. Now, that doesn't mean that we only stay in our home for 3 to 6 years. I want you to think about this. Think of your parents, your cousins, brothers, sisters. Think of yourself. Anyone you know that has owned a home, let's say for the last 10 years. The chances are they've either moved, so they're not even in the same home, or they have refinanced sometimes to the tune of 2 or 3 times. I've refinanced one of my properties 3 times in the last 10 years, which means every 3.33 years or so, I'm refinancing. Still own the home, but certain things occur every 3 to 6 years that make us refinance or change our mortgage structure. So here we are as a society so focused on the 30-year fixed, when in all reality, we're saying, give me a higher rate so I can feel comfortable, but reality is I'm not going to be in this mortgage for 30 years. You should think about that, okay? Something else, lower rate, lower payment. Most importantly, you pay down your mortgage faster. If you were to get a loan today at 1.75%, $300,000 balance, get a $300,000 loan at, let's just say 4%, and you put 2 amortization tables side by side. You can do this online. And you said, okay, let's just happen to say my payment, and this is, I'm just going to make up this number. It's $1,000 at 1.75, and it's $1,500 at this 30-year rate. So it's the same house. You can choose to pay $1,000 every single month, or you can choose to pay $1,500 every single month. Your choice. Even though you pay less money on your adjustable rate mortgage, you pay your balance down faster. Go look at your amortization schedule in year 2, year 3, year 5. What you owe the bank, even though you're sending them less money, is also less. That's called building equity faster through the VA's ARM program than you would on a 30-year fix. So again, you've got to do this scale at your own house. Do some more research. On our website at Low VA Rates, we have tons of amazing videos on our YouTube station. Just go to YouTube, search Low VA Rates, and do this exercise on your own. List all the reasons why you don't think you should do an adjustable rate mortgage. List all the reasons why you think you do. And I believe, like so many others, you'll come to the same conclusion we have. The pros will outweigh the cons, and you will be glad that you used the VA's Hybrid ARM loan program. Thanks for watching. Tune in next week. Give us a call if you have any questions. Thank you.